All right, ladies and gentlemen, welcome to today's 1031 Exchange webinar. You guys are in for a treat because we're doing a live webinar with the best in the business. Between the three of us here, we've got over 60 years of experience in the 1031 Exchange business, and 55 of that is with Phil Atwan. So very, very excited to have you guys here and to share our knowledge with you. So first, what I'd like to do is just kind of introduce our 1031 Exchange panel, and I guess I'll start. I'm going to be the moderator today, and my name is Leonard Spoto, and I've been in the business for 20-something years now, started Asset Exchange Company almost 20 years ago. I've got Phil Atwan with me, who many of you also know as a multi-decade veteran of the exchange business. Phil, why don't you give an introduction, tell a little bit about yourself.
Hi, everyone. I'm Phil Atwan, and it's a pleasure to come back with you again today. I've been around since 1982. That isn't when I was born, but that's when I first began in the industry. And I remember interest rates had just dropped all the way down to 18.5%. So we were heading in the right direction. Things have evolved, and I went from title insurance to the 1031 exchange business. So I've enjoyed many decades of working with so many of you and those before you, and looking forward to this education today of how to create new business and how to understand how the exchange works.
And then I don't think, Adam, you were born in 1982, although you might have been because you're a lot younger than both Phil and I. But what about yourself, Adam?
Yeah, I started in the commercial real estate business, and 1031 exchanges were such a big part of that business, as well as such a positive thing to be a part of, deferring capital gains taxes. So I've been doing it for about 9 years now, and I've been part of many 1031 exchanges, and just excited to be on this panel with such veterans.
You never got that date of birth, though.
All right, so what we're going to do today is we're going to kind of ping pong back and forth and give you guys who are on the call with us some nuggets of information about the 1031 exchange process. But I do have a couple housekeeping items before we get started. So the first and foremost is, if you guys have questions about anything that we're talking about, you have the ability to lob your question over to us, and I'm going to moderate the questions and then answer them, or have one of the guys here answer the questions as they are appropriate. So the way that you ask a question on the 1031 Exchange webinar here with us is you type it into the questions dialog box on your control panel. So you have a little control panel there. Type in your question. It will come up on my computer screen. I'll be monitoring the questions throughout today's discussion, and we'll try to answer all of those questions as appropriate. Now, if we don't get to your question, don't worry. It's probably because we're going to cover that specific topic in a later slide during our conversation, or we're just not going to have enough time. And if we don't have enough time for all the questions that come over, don't worry. We will shoot you an email addressing your specific question, and we'll make sure that we get it answered. So, are you guys ready? Adam, Phil, you guys ready?
Yes, let's do it.
All right, let's jump in. So we are a 1031 exchange accommodator. So our company does not sell title insurance. We do not sell escrow services. The only thing that we do is facilitate 1031 exchanges. So as a 1031 exchange accommodator, we only work with people who are doing 1031 exchanges, right? They're going to sell an investment property, defer taxes, and go out and buy another investment property. So three very important components of what we do. Number one, we're going to hold all of the sale proceeds that come from the sale property. If your escrow officer cuts you a check and you take that money, you are paying taxes. If you don't want to pay taxes, you need to make sure that you have your exchange account set up, and the funds will come over to the custodial account that our company sets up for you. Number two, we're going to prepare all the legal documents that are required to properly document the transaction as an exchange. And then we're going to make sure that you are in compliance with all the rules and regulations set forth within Section 1031 of the Internal Revenue Code. Now, as I mentioned before, we've been all doing this for a very long time, but I actually started the company with my business partner, who's a tax attorney, back in 2006. So we're almost ready to celebrate our 20-year anniversary. We are licensed, excuse me, we are bonded and insured. So our company carries a significant fidelity bond, and we also have E&O insurance to cover any mistakes or potential mistakes we could make. As I mentioned, tax attorney is on the team. That's my business partner, Adam Skarsgård. He's both a member of the California Board of Accountancy and the State Bar. And then one of the unique things about us is that we are the only firm in the industry that will offer our clients audit support if they do an exchange with us and they get audited by the IRS. Now, this is very, very important. We cannot represent you in tax court, but what we're going to do is we're going to help you substantiate the position you took to the auditors. So we're going to provide you with all the arguments and the private letter rulings and the tax court opinions that will substantiate any risky position you took in the exchange, so that you can hopefully avoid hiring a $500 or more tax attorney to represent you in tax court. So just a little bit of background about us, and obviously we'd love it if after this webinar you decided to use us on your next upcoming 1031 exchange. It's why we do these webinars, right? We're looking for your business and to be on your team as a 1031 exchange accommodator. So let's talk 1031. So Section 1031 of the Internal Revenue Code has been called the single greatest wealth building tool available to the investor. Now, why is that? Well, it is because when you do a 1031 exchange, you can defer paying your capital gains tax liability on the sale of your investment property. And the rule of thumb is that if you don't do an exchange, you're going to send about 33% of your gain to the government in the form of capital gains tax liability. So I always like to joke that whenever I do a deal, I've got three partners. I've got myself, I've got my spouse, and I've got the government. Now, the great thing is I can get away with the 1031 exchange with not getting the government to get their share. My wife is always going to get her share, right? I'm going to hopefully get to keep my share. But one of the great things about 1031 exchange is we can eliminate that third partner, the government, from getting their share of the sale proceeds. So Section 1031 allows you to take money that would have gone to the government, keep it in your pocket, and use that money to leverage into bigger and better properties. So one of the greatest pieces of tax law, in my opinion, on the books, Section 1031 of the Internal Revenue Code. So I mentioned 33%, right? But a lot of you are thinking, well, geez, I didn't know it was 33%. I thought it was 15%. Well, Phil, why don't you walk us through why it's not 15% and why my number of 33% is a little bit more accurate?
Leonard, that's a good question. Many people call me and say, maybe I should just pay the 15% and be done with it, and I don't have to worry about a 1031 exchange. And my first response is, pick up my phone and say, excuse me, who told you it was 15%? There are 4 different taxes you pay when you sell investment real estate. Number 1, you pay long-term capital gains tax as long as you've had title to the property for a year and a day or longer. And that 15% is a range. It could be as high as 20. And that's what your CPA will calculate. It has nothing to do with how much equity you have in the building. Nothing at all. It's about the capital gain. And the capital gain typically will be fixed on certain items that we might cover a little later on in this video. Number 2, you also pay a depreciation recapture tax. What's that? Well, during the life of the property that you own it, your CPA will separate the purchase price into 2 categories: the value of the land, the value of the building. The land is not depreciable, but the building and its improvements are. And if it's a residential building, you get to depreciate the value of the building divided by 27.5 years equals how much depreciation you will take every year over the next 27.5 years, assuming you don't do any capital improvements. If you do, it begins another layer of depreciation that you can take. Well, what happens is whether you take this depreciation or not, and some people elect not to take the depreciation, but what happens is this depreciation is what they call allowable. Allowable means you can take it or not. But even if you don't take it, the federal government will send you a tax bill, or your CPA will give you a tax bill of 25% of the allowable depreciation, whether you took it or not. So that's if you had at least, let's say $400,000 of depreciation, you owe an additional $100,000 to the 15%. But there's also a Medicare tax to the federal government. When they passed the Affordable Health Care Act, they said that anytime, whether it's stocks or bonds or mutual funds or any kind of real property sale, you will have an additional 3.8% on top of your 15 or 20%, whatever that long-term capital gain happens to be for you. So you get to pay that into the healthcare system. That's assuming that your gain is at least $200,000 or more, and most people's are, as an individual, or $250,000 or more as a married couple. And the last tax that, I don't know if you want me to talk about this because it's not on this page, Leonard, is the state of California. Welcome to California. There you go. And California has a range now. On average, it's going to be between 9.3 to the new rate hike of 14.4%. So that means it's an ordinary income tax rate. It's not a long-term capital gains rate, which means whatever you sell, your personal residence, your second home, your vacation home, your rental property, well, not only you pay that normal ordinary income rate to the state of California, which will be in that range I just went over, but in addition to that, everything else that you pay in taxes that year, in terms of what you've earned in interest, or your wages, or your commissions, that's all raised into that category. So you're probably going to be not too far away from the ceiling, especially if you sell a property with some significant capital gain in it. Well, those are the big four taxes you pay if you don't do a 1031 exchange on the sale of your investment or business use property.
Yeah, now one of the things that's important to note is a lot of people think that they don't have an idea of how to calculate their gain, right? They think, well, geez, I sell my property, I pay off my loan, the money that's left over must be my profit, right? That's not how it works, okay? The way that you actually figure out your capital gain and hence your tax liability is you have to take your net sale price and subtract out your basis. Now, of course, that's going to beg the question, well, geez, what the heck is my basis? And Phil kind of touched a little bit on this. The way that you figure out your cost basis in the property is you're going to take your purchase price, subtract out that allowable depreciation, and then add back in your capital improvements. So let's do a real quick example, right? So here's my kind of fact pattern. I went out and I bought a property for $500,000 many years ago. And over the course of ownership of that property, I've taken a total of $100,000 in depreciation. At some point during my ownership, I had to put a new roof on. That cost me $25,000. That's a capital improvement. And then I sold the property for a net sale price after commission and closing costs of $1 million. All right, so it's very important. Our net sale price is $1 million after we took out our commission and non-recurring closing costs. So this is all the information your CPA is going to need to figure out your tax bill. All right, so first thing that we're going to do is we're going to start with figuring out what our basis is. As I mentioned, purchase price minus your depreciation, add back that new roof and any other big improvements that you did to get your cost basis, your adjusted basis. Now, the problem here is if you sell the property for anything above your basis, you're going to have a gain. And in this case, we've got a gain in my fictitious example here of $575,000. Now we're going to go out, we're going to apply all of those tax rates that Phil just talked about. And you can see here that when all is said and done, you're going to have a very large tax liability. Okay. Almost 200,000 bucks is going to go to the government if you choose not to do an exchange. And many of your clients, many of you will choose not to do an exchange, and that's perfectly acceptable. However, if you're looking to build wealth through real estate, one of the best things that you can do is not send $184 to the government. Instead, keep that money in your pocket and go out and leverage into bigger and better deals. All right. Now, one of the things that we always advise you is, don't crunch these numbers for your clients. If you're a real estate agent, just say, hey, about 33% or 1/3 of your gain over here is going to go to pay taxes. Let the CPAs crunch the numbers, because we're not going to know what kind of improvements and what kind of depreciation schedules our clients have. That stuff can get really tricky, but back of the napkin math is really fun and easy to do with the client, and you can really show them the power that the 1031 exchange can have when you present, geez, $200,000 going to the government or $200,000 staying in your pocket. All right. So the great thing about real estate is you do have fantastic opportunities to mitigate that tax liability. So as we were talking about earlier, real estate is one of the most kind of tax advantaged investments that are out there. Today's talk all about investment property, and with investment property, you get that power of the deferral. But before we go too far into 1031 exchange rules and regulations, I do want to mention that there's one other tax break available as well. It's for your primary residence. That is section 121 of the Internal Revenue Code. And Adam, what is section 121 of the Internal Revenue Code?
Yeah, of course. So whenever you're representing a client selling their primary residence, meaning this is not their second home, this is not an investment property, it's their primary residence, they are eligible to exclude $250,000 of capital gain if they're single, or $500,000 of capital gain if they're married, in tax-free money. And so primarily the Section 121 exclusion is better than the 1031 exchange in the sense that it allows you to take tax-free money without having to reinvest it, but it is only for primary residences, meaning it was your primary residence for 2 of the last 5 years, which is a very important detail.
Yeah, Section 121, the homeowner's exemption. Most of you are familiar with the homeowner's exemption. Now, the reason why we talk about it is because your clients often get confused, right? They think, well, geez, do I do an exchange on my home? Do I take the homeowner's exemption on my rental? No. All right. We've got 2 tax laws, very different. One is for your investment property, and one is a tax deferral. That's Section 1031. The other is complete tax avoidance on a portion or hopefully all of your gain, and that is only for your primary residence. Now, the great thing about these tax laws, though, is that they are not mutually exclusive. And what I mean by that is there are opportunities where you can use these 2 tax laws together on the sale of one property. So, Adam, what's a good example of one of your clients using the homeowner's exemption and 1031 together?
Yeah, so for investors or primary residence holders that basically have lived in a property for a long time, if they move out of it and convert it into a rental and rent that property out for at least 2 years, they are actually eligible to take the 121 exclusion, meaning if they're single, $250,000, if they're married, $500,000, tax-free off the top, and then they can roll the balance into a 1031 exchange and defer the taxes using the 1031 exchange. So it gives you an option to kind of combine both parts of the tax code.
Yeah, so this is very important, guys. So if you live in a property, let's say you bought a property at the beach in Manhattan Beach a long time ago for $1 million. You've lived in it for 20 years. It's worth $5 million now. You've got a significant amount of gain in excess of your homeowner's exemption, right? You've got $4 million of gain. And even if you're married, the best you can do is avoid taxes on $500,000. So what do? Well, you either pay that big tax bill, or you can move out of your highly appreciated home, convert it to a rental, and then after you've established it as a rental for hopefully long enough, 2 years we recommend, you then sell it as a 1031 exchange, but also take your homeowner's exemption. So you can combine the homeowner's exemption and the 1031 exchange and walk away from the sale of that property with zero tax liability. And then Phil, I think you probably have seen this in your career. What about a client who lives in a duplex, lives in the top and rents out the bottom? Can they do the same thing here? How does that work?
Duplex, an ADU, they live in one unit, the other 3 are rented or whatever. The CPA will then split up the gain. There's a gain for the principal residence portion of the sale, and there's a gain for the investment property portion of the sale. On the personal residence side, they'll get up to the 250 or up to the 500, depending if they're married or single, but only on that part. On the other part that is investment or business use, then they'll be able to set up a 1031 exchange on that portion of the sale and exchange that into other investment real estate.
So, hey, Phil, what about Janet wants to know, what if you've got an owner or a property that's owned by a mother and a son? Let's talk about the situation where a mom and a son own a rental together. And then after that, let's talk about a situation where a mom and a son own a primary residence together. What tax breaks are available there and how's it work?
Well, on a principal residence, if there's 2 people on title, depending on what their percentage is, let's say it's 50-50 for this example, then half of the gain belongs to the mom, half of the gain belongs to the son. Each one, assuming that they're single, will get up to $250,000 of capital gain for their portion of the gain. That's if they both live in it. But what was the other request, the other example?
Mom and son own a rental together.
Oh, I see. If they own a rental together, we can set up 2 exchanges, one for each party to do their own 1031 exchange, or if they want, they could buy something together with their own individual exchanges, and that's very doable. Or one may want to do an exchange and the other party may not opt to want to do it because of their tenant in common relationship that they have with each other. So they can do either one. They have a couple of options.
Yeah, the great thing about the tax law is it's per taxpayer, right? So you could have 15 taxpayers on title and you can have 15 different exchanges, or if it's one giant house and all 15, adults live there, claiming it as their primary residence, you might have 15 different homeowners exemptions. So
or even 15 LLCs that own a big commercial building.
Yeah.
If they're tenants in common, they can go their separate ways.
Yep. And Ian has a good question, Adam. Is the homeowner's exemption going to help you avoid both state and federal, or just federal?
Yeah, the homeowner exemption is going to help you avoid all of the federal and state taxes on the sale of that property.
And then what about renting out rooms in your primary residence, Adam? How would that work?
Yeah, this is I'm going to defer to your CPA, but they're gonna take a section of the house and they're going to give you some exemption if you've been filing and writing off that property as an investment and those rooms as a rental. They're the ones that are going to do that calculation for you to give you the value of your 1031 exchange versus the rest of the house, right?
Yeah, it's not as easy as saying, well, geez, I have 4 bedrooms and I rent out 2 of them, so I get to exchange 50%, right? Unfortunately, it doesn't work like that. The other thing that I hope you guys noticed Adam said was you've been reporting rental income. What happens a lot of times is people come to us and say, well, geez, I've got, part of this house rented out. And I say, well, have you been collecting rent? And sometimes the answer is no. And if the answer is no, that's going to be problematic because you really haven't established on your tax filings that this property was used as an investment, right? And a lot of people like to not report rent so that they can not have to pay taxes on that rent. The problem is, when it comes time to sell, now you've got that capital gains tax liability. And it's really hard to prove that you're eligible to do an exchange when you haven't been reporting rental income to the government. So you got to weigh which one's more important to you.
Yeah, it could be tax fraud as well, not reporting the income.
Yep, that is true. All right, so let's keep our noses clean. We don't want to commit tax fraud. Let's talk about how we stay true. We don't want any tax fraud, so what do? Let's talk about the first guideline for a successful 1031 exchange. Phil, take it away on what type of properties qualify. What do we have to do?
Well, here's the bottom line. The government allows you to exchange domestic property for domestic property. That means if you're selling something here in the US, you could exchange it for anything in the US. In some cases, you could even go into a US territory like Guam, Puerto Rico, US Virgin Islands. You should check with your CPA about that. Foreign property is not like kind to domestic property. However, if you're selling a property in Canada and you want to buy a property in South America or somewhere in the Middle East, you may do that because it's foreign for foreign. You cannot intermix both domestic and foreign property in a 1031 exchange. It's just not allowed. So be careful to make sure that your CPA understands what you're trying to do and they're approving it.
What about quick flips, Adam? Can I exchange my quick flips?
Yeah, so Section 1031 is only for long-term investment property, which means at least longer than a year. When you think of short-term capital gain taxes, home flippers and people that this is their business, it's going to look like that on your tax returns. You know, those people are paying short-term capital gain tax, whereas if you held the property for long-term investment, you're typically a year, longer than a year, probably longer than 2 years, and many of our clients longer than 20 years. So it's long-term investment only.
Yeah, and people get frustrated because they sometimes think that we're not giving them a straight answer, right? When they ask, how long do I have to own this property for it to be eligible? The reason why we can't give you an exact number of days, weeks, months, or years that you need to rent the property out is because the government doesn't tell us, right? What they tell us is that your property needs to be used for productive trade, for business, or investment. Okay, they don't say if you rent a property out for exactly this long, you're automatically eligible for 1031. It's a little bit grayer than that, and they rely on some of that gray area to kind of investigate what they think just might not be a legitimate transaction. So what we know here in California is that the Franchise Tax Board kind of likes to see 2 years, 24 months. And if you have that, you should be okay. Now, does that mean if you don't have 2 years, it's not going to be okay? Well, it depends on your facts and circumstances, right? If you have a client who has owned a rental for 15 months and then their job transfers them to New York City and they don't want to manage a property all the way across the country, they do an exchange and they have a good fact pattern, then they should be okay, right? So there is some gray area that we kind of dance within that kind of how long when we talk to people, how long do you need to own the property? And a lot of it just depends on your facts and circumstances of how you use the property, what's going on with your life, things like that. So if you're getting a hard and fast answer from someone else, it's probably not a right answer because it depends on a lot more than just how long you've owned the property. What they're going to look at is your intent. Right, Phil?
And yeah, in fact, some people say, well, they bought a property, they improved it, they built a building on it. It was over a year. Now they should be able to exchange it. Well, unfortunately, it didn't go into service until after it was created and built, not the time of acquisition of that land or whatever they bought. So the bottom line is be careful. Talk to your CPA. Have your clients talk to their CPAs. Don't give tax or legal advice, just like we don't, because we're not licensed and they are.
Yeah, let me ask one other question. I'm gonna throw this one to Adam. Adam, I've got a vacation property up in Tahoe. Can I exchange that?
Yeah, so there's some specific revenue procedures that on how to treat second homes or properties that you're using potentially personally for part of the year. And they limit you to 14 days or 10% of the time it's rented. So you can use that Tahoe vacation property for 14 days, or let's just say you rented it for 200 days in the year, you could use it for 20 days. And so they do allow some personal use of these properties, but remember, this is for investment or business use primarily. So you want to make sure that you have a good fact pattern that supports that this is an investment property.
Yeah, so the answer that I usually give when someone says, can I exchange my rent, my vacation property, I usually say, I don't know. How long have you used it personally, or did you have any personal use on it? If so, how much? A lot of times the conversation, however, will go like this. Well, yeah, how long did you use it? And they'll say, well, I don't know. How long do I need to have used it? And I said, well, you can't use it for more than 14 days or 10%. And they said, okay, well, then I use it for 13, right? How's the government going to know? So that's kind of a typical conversation we have with the clients. And, you know, again, it's all about risk tolerance. You know, if you use the property for 20 days, but you exchange it and the government finds out you used it for 20 days, well, you're going to have a problem. Now, how are they going to find out? Right? It's up to them how aggressive they are with their audit. So you will take on your own risk kind of assessments and decide with the information we give you what you plan on doing.
And be careful with all those drones flying above. They may be watching you. No, I'm just kidding.
All right, so rule number one, make sure your properties are eligible for exchange. If you have any question at all, what I want you to do is this. Pick up the phone, call a toll-free number behind, talk to Phil, talk to Adam, talk to myself. We will help you make a risk assessment on whether you can do an exchange or not. Rule number two, what do we have to do to defer all of our taxes, Mr. Adam?
So I like to give everyone this formula for full tax deferral, right? And this formula, you basically take your gross sale price and you minus your non-reoccurring closing cost. So escrow, title, your commissions, everything that's involved in the sale of this investment property. And let's just say you had $1 million sale with $50,000 in non-reoccurring closing cost. That would mean your target replacement value is $950,000. And that means rolling over all of the equity that you get from your sale and getting a new loan of equal or greater value. So you'll notice it has nothing to do with your basis in the property. It has nothing to do with the debt to equity ratios. It's simply your gross sale price minus those non-reoccurring closing costs equals that target replacement property for full tax deferral. A lot of our clients, they think that their deal is going to get blown up because they bought something for $900,000, right? And they needed $950,000. Fortunately, they can simply pay prorated taxes on the difference, and it's not the end of the world. You know, I get a lot of panicked phone calls with clients that are like, this was the perfect property, it just didn't cost enough, you know, and we get to share the news that, hey, it's all right, you just pay prorated taxes on the balance. But you want to make sure that you're reinvesting all of the equity that comes from your sale and getting a new loan of equal or greater value. Now that new loan can be a conventional loan. It can be the seller offered seller financing for that amount. It could also mean you don't want debt on the replacement property. So you're going to bring in the exact cash equivalent from the payoff statement on the relinquished property and bring that into the purchase for an all cash purchase. All the proceeds we're holding for you, plus the cash that's going to substitute for the loan. So I guess the short answer is gross sale price minus non-recurring closing costs equals full tax deferral.
Yeah, so I'm going to ask you a question on that, Adam, but I do want to tell a funny story. So I had a client said, hey, my replacement property is a little bit less expensive. Should I offer more? No, never offer more money. All right, because what you'd be doing is you'd be spending $1 to save 33 cents. You never want to do that. Okay, it's always better just to pay your taxes, get a better deal on the property. Now, the question I have for you though, Adam, is multi-property exchanges. Are they allowed? Can I sell multiple, buy one, vice versa, sell a bunch, trade into one? How does that work?
Yeah, of course. So I actually was on the phone with a client today, and they're selling multiple properties, right? And their hope is to combine the proceeds from both of the sales into one purchase. So it was 2 condos for roughly $500,000 each, and their hope is to sell both of those and buy one property for $1 million total. And so I told them that this is definitely possible, but you have to make sure you're aware of all those time frames and that you're buying equal to or greater in value on the purchase side. Now, the second part of that question was, well, what happens if one of them I sold was all cash and one of them had a really large loan on it? Well, you just want to make sure, again, you roll in all the equity and get a new loan of equal or greater value. And it goes the other way around as well. Like I have a lot of clients that they might sell a property for $1 million and buy 3 properties for $330,000 each, or just over $350,000 each. And that's fine as well. So as long as you're spending equal to or greater, then you're going to be fully tax deferred. Now, I will warn you, we have had clients that have tried to buy 3 properties, and what happens is if one of them falls through, well, they're going to end up short of that $300 and something thousand, which could mitigate some of the benefit of the 1031 exchange.
Phil, you look like you're chomping at the bit here to jump in. What do you got for us? Anything?
You're right on target. This is all good information, folks. And you could also buy with other people. So for example, let's say I'm selling a property for $1 million, but I want to buy with Leonard and Adam a property. Now, how much do I have to acquire? The answer is my fractionalized interest, whether it's 50% or 10% or 90%, has to be $1 million or greater. So if we wanted to buy a $3 million property and I'm selling for $1 million, I have to own at least 1/3 of that. And that part as a tenant in common with the other 2 would suffice for my 1031 exchange, whether they're exchanging or not.
Yeah, and I'm going to answer one of the questions that popped up on my screen, and bear with me because there's a lot of questions that are popping up, and I promise you if we're not getting to them right away, we'll hang on the call and make sure all of your questions are answered at the end. But Mike wanted to know, he's got a client who sells an investment property, he wants to buy a duplex. Can he live in one of the units on the duplex? And yeah, that works as long as the value of the rental component of that duplex satisfies his exchange requirement, right? So if he sold $1 million worth of investment property and he buys a 2-unit building for $2 million and rents out half of it, that would work, right? And then I have another person that wants to say hi to you, Phil. Vivian says, hello to Phil. He's done all my exchanges from California to Arizona. So hello, Vivian.
I hope it's going well out there in Phoenix and you're not too hot.
Yeah. All right. Walk me through the time frame, Phil. How long do I get to do my exchange?
Well, it depends obviously what kind of exchange you're doing. In this case, we're talking about a typical delayed exchange. So we have to set up the exchange with the escrow officer before escrow closes. That includes getting the DocuSigns all set up by the seller. Once we set it up, now you're free to close your sale at any point. When the sale does close, you have 180 days to close escrow on whatever you're going to acquire. If that 180th day lands on a weekend or a holiday, you do not get the next business day. It's that day or before. So weekends, holidays do not give you the benefit of being able to go to the next business day. Remember, it's also 180 days. It's not 6 months. Technically and legally, 180 days is a few days less than 6 months. So don't tell your client 6 months. So you have that 180-day span to complete your exchange and take title to your new property. However, when Starker was fighting with the government, ultimately what happened is they wanted his case, but the IRS says, not so fast. We're going to give you a 45-day window, the first 45 days of that 180 days, to name the addresses of the property or properties you would like to acquire. So at the end of day 45, because you can change that 45-day list of all the properties that you would like to acquire, under the 3-property rule, you can't have more than 3 properties on that list. The property you're buying or the properties you're going to buy must be present on that list at the end of day 45. So those are the 2 time periods you're working with. The 3-property rule, up to 3 different properties to acquire. You don't have to buy all 3. You can just buy one of the 3 as long as you do with both what Adam and Leonard told you, that you use all the cash and you replace the debt. But some investors need to buy more than 3 properties, whether they're going to agricultural property here in the state or they want to go to other states where the values are lower. So they can acquire multiple properties, but they must identify in that 45 days not to exceed 200% of the sales price. What does that mean? If I sold for $1 million, I times 2, which 200% is a $2 million cap on how many values I can identify of all my identifications in that 45 days. And at the end of day 45, if I have 5 properties, 10 properties, 20 properties that are identified by address or legal description or parcel number, along with its fair market value, the values have to be calculated together. The total values of all properties, which is a 200% cap of $1 million, which is $2 million, all the properties do not exceed the $2 million range, then you can buy whatever you need to fulfill your exchange off that identification list. 200% rule could be tricky. Don't forget to give us a call if you have any questions about it.
Yeah, so a lot to unpack here, right? So we've got our day 45 that's within our 180-day time frame. So we have a window to complete the exchange. Within there, we have to identify. Your biggest challenge, whether you're doing your own exchanges or you're working with a client, is going to be managing that time frame. Now, my best advice to you is manage that time frame well. And the way you can do that is you don't start your exchange until you close escrow. So if you don't know what you want to buy and you put your property on the market and you immediately get an all cash offer and a 7-day close, that might not be a good offer for you to take because you're going to start your exchange in 7 days. You have no clue what you're buying, right? So if you can manage your escrow period, maybe be 30 days or 60 days or 90 days, then you're going to have more time to go out and look for suitable replacement property before you close and have a greater chance of successfully completing your exchange. So I always tell clients who are nervous about the exchange and the time frame is, hey, that time frame can be managed by the date that you close escrow. So if you're not ready to close in 7 days, don't do it. Wait a little bit of time, right? Now, the only other way that you can get more time for your 1031 exchange is what, Adam?
To not close escrow. It's simple.
Yeah, sorry, I set you up on that one. I should have told you what I was looking for was a presidential disaster declaration, right? So there are times when you may get more time to complete your exchange, but it's going to require a hurricane, a flood, a fire, some kind of big natural disaster where the government steps in and says, hey, we're going to grant tax extensions. And unfortunately, we have those all the time now, right? We had the Los Angeles fires recently where a lot of our clients got extensions. Every season in Florida, we get hurricanes and our clients out there are getting extensions. So it does happen where the government will just give you more time if you're affected by one of those disasters. My advice though is do not count on it, okay? Because when you need it, it's not gonna happen, right? So manage your expectations, your clients' expectations. Tell them, hey, you've got 180 days. The only way we can really manage this time frame is by controlling our close of escrow date. All right. So Phil walked you through kind of the third and fourth guideline here. So you got your time frame, and then you got your rules for identifying. And I know there's been some questions about some LA specific stuff, but you want to walk through that presidential disaster that we just had, Phil, and it's kind of almost not relevant anymore, but you can kind of talk a little bit about it.
But where we are right now, if you're able to close your sale obviously after April 18th, but before August 31st, you receive an extension on your identification deadline to October 15th. So that could give you extra days depending on when you're closing, which exceeds the 45 days. So my suggestion is take a copy of this and we'll be happy to email it to you. Give it to your clients or their CPA and have them approve that they qualify for this disaster extension, or they're an affected person by, their property doesn't have to burn down to be qualified by this, but have your CPA put their stamp of approval on it.
Yeah, we can tell you if and when there are disasters. We can't tell you with definity or with certainty that you qualify for the extension. So we'll tell you, hey, there's an extension. Make sure you talk to your CPA to see if you qualify for that extension. Now, Phil, or let me lob this one to Adam. So we talked a little bit, or Phil talked a little bit about the 3 property identification rule, which is, I think, probably the most common for our clients, right? They usually nominate 1, 2, or 3 properties. But we do have a question about what happens if none of those work out? What do we do, Adam?
Yeah, if there's no disaster extension, then you can potentially fail your exchange if you can't buy any of those identified properties and it's after the 45th day. So you want to make sure that you have a reasonable chance of purchasing one of those properties. And a lot of our clients, they always say, well, do we have to be in contract during the 45 days? No, you don't have to be, but of course, that's a huge benefit towards, a successful exchange if you can get into escrow and at least have a good chance of buying one or more of those identified properties.
Yeah, so worst case scenario is you pay taxes, and sometimes that happens, right? What we don't want you to do is go out and make a really bad decision to buy an awful property just to save your exchange, because that might be more liability, more hazard than just paying your taxes. So sometimes worst case scenario, you fail your exchange and you just pay taxes, but some people are okay with that, and sometimes that's the best option, right?
Now, times I tell our clients, excuse me, many times I've told our clients, if you think you're just going to buy one property, identify a second one at least. Have a backup plan just in case that report comes back on that property and inspection doesn't look good and it's a bad property for you. Have a backup, because once you pass that 45 days, you cannot alter that identification.
Yeah. Okay. So moving on. So we've talked about our 4 requirements, 4 guidelines. We've got guideline number 1, your properties are eligible. Number 2, reinvest all your cash and purchase property equal or greater in value to defer all your taxes. You've got 180 days to do your exchange, and you have to identify on time. These are very important guidelines to remember. If you are like me and you leave a webinar and forget 50% of what we talked about or more, that's okay. The only thing that I really want you to remember is our phone number. If you haven't done it yet, put our phone number into your cell phone right now, because in 3 days, 3 months, or 3 years, when your client asks you, hey, what is that 200% rule? I heard about that, and you forget, pick up a phone. You've got Phil, you've got Adam, you've got myself, you've got all of our team here that are available to consult with you and your clients all the time about this stuff. All right. So you know what I'm going to do, because we're running out of time. I do have some more slides, but I'm going to jump to the end of our presentation here. I'm going to put all of our contact information here. So you've got Phil, and I know Ziggy has used Phil for all of his exchanges and looks forward to doing more. So say hello to Ziggy, Phil.
Hey, Ziggy, I hope the NAR is going well for you. I know you got a lot of work up there.
Ziggy's probably already got Phil's phone number saved, but we want to make sure it's the right one, Ziggy. So put 323-570-1031 into your cell phone. We've got Adam's phone number and my phone number as well. Pick one, doesn't matter who. We all work as a team here. So use us as a resource. And what I'm going to do for the remainder, we've got about 10 minutes left. I'm going to go through some of these questions here that have popped up on our computer screen to make sure that you guys have the answers you need from this webinar. So I'm going to throw the easy one out here. Janice wants to know, Phil, can you exchange into land?
Yeah, absolutely, because the government says you can hold vacant land for the purpose of appreciation. Obviously, you're not going to be able to charge a lot of rent on that land, unless, of course, you're by the Coliseum where you can hit people up for $100 to park their car, or if you want to put pumpkins on it in October and Christmas trees on it in December. Other than that, it really doesn't generate income. But if you're holding it for investment, or in this case, appreciation, it qualifies whether you're going into vacant land or out of vacant land into any kind of investment real estate.
I'm going to lob one more at you, Phil, since you're the LA expert. What role does the ULA tax play in 1031 exchange? Are they related? Are they separate? What is the ULA tax?
It's also known as the mansion tax here in Los Angeles. here's the bottom line. If your sale qualifies for it, it's usually $5,300,000 or greater, any kind of property that's investment. You will pay a huge 4% transfer tax. It's not deferred under the 1031 tax deferred exchange. That's the bad news. The good news is, as Adam was saying, you can pay for it out of your non-recurring cost to sell, because it is a one-time cost to sell. The bad news is you have to pay it, but the good news is that it can be paid out of the equity of the property and not out of your pocket to sell the property.
So Adam, Cynthia wants to know if we can move into our exchange properties. What are the things we want to watch out for if that's our plan?
Yeah, so the IRS is really keen on the intent of doing the exchange. So they're looking for intent for long-term investment property. So if you plan on converting your property, I think the best thing you can do is to go talk to your CPA and make sure they feel comfortable with whatever circumstances are causing you to move into the rental property. Because a lot of our clients, they end up, what happens if you get divorced, someone dies, or you just decide, what, I'm gonna move into this investment property, out in Palm Springs, and maybe it's been 10 years since you've done your exchange, and your CPA might say, you know what, it's been long enough. It was your intent to do long-term investment, and you may qualify. So the best thing you can do is to pick up the phone and to talk to your CPA.
Yeah, my rule of thumb is don't even try it before 2 years, right? And if you're buying a property and you as an exchange and you're thinking, well, geez, I'll rent it out for a year and a day, then I'll move into it. You get to audit it, you're going to get disqualified, right? You really want to make it look and smell and feel like a real legitimate investment before you ever move into it. All right, my dreaded question that always comes up on every single webinar. What about a reverse exchange? Mr. Nishikawa, what is a reverse exchange?
So if you are representing an investor who says, you know what, I don't want to risk 45 days of not finding the perfect property, the reverse exchange is their opportunity to close escrow on the purchase property before they sell. And it's literally just flip-flopped on the time frame. You take your date of acquisition, you've got 45 days to identify your potential sale properties, which property in their portfolio do they plan on selling, and then they need to sell that property no longer than 180 days after the acquisition, close on the sale. So it's literally just flip-flopped on the time frames, but it does allow your investor to close on the purchase property before they sell. So it does take some of that risk away. I mean, some of our clients, their tenants have 2 months left on the lease and they find the perfect replacement property. And so this is a solution for them.
Now, why did I speak with such dread about the reverse exchange? Well, the reason is because they're just hard to do. They're hard to finance. There are duplicate escrow title fees involved, and there's duplicate transfer taxes, because in a reverse, yes, you're buying the new property first, but you can't go on title to that new property until your old one has sold. So what we do to facilitate the reverse is we become the straw buyer for the property that you're buying. And when you're going to Wells Fargo and asking for a $2 million loan to buy a property, and they learn that you're not taking title to it, we are, the lender typically backs out. Right, there are some lenders that do it. So there's hard money lenders. There's some banks that will as well, but financing can be challenging. So just keep that in mind when you're talking to clients about reverse exchanges. They're going to be more expensive. They're going to be challenging to get financing. Now, in that same vein, Phil, someone had asked, can I use my 1031 exchange dollars to build or improve a property?
It depends. The answer is no if you're doing a traditional delayed exchange. The answer is yes if you do a construction or an improvement, or what we call a build-to-suit exchange. It has the same feel of a delayed exchange, 180 days to take title to the new property you're buying, with a 45-day window to identify, but all the improvements must be identified, and the address of what you're going to buy must be identified in the 45th day. And then when you receive title to the property, you don't get property, we do. We have to hold it. And then after all the building has been done, we present the property to you before the end of the 180 days, all your cash had to go into not only the acquisition, but into the capital improvements of that property, as well as the identification of it in the 45 days.
I'm sorry, Phil, how long did you say I had to spend my money on completed construction?
Yeah, you just had to bring that up, didn't you, Leonard? I know it's hard to do anything in 180 days, much less close a purchase, have us take title to it, have the contractor ready to go, have the permits. I mean, have all your entitlements ready to go, get the contractor out there and start hammering and building, and then take the property at the end of the 180 days. If there's any cash left over and you were not able to get that done, you will pay taxes or boot on the cash that did not go into the acquisition. Same for debt. But the bottom line is, if you could meet these time deadlines, and this will cost you because it's a lot more expensive. We're talking reverse money or even more to do a build to suit or a construction exchange, then it would be a good thing for you. But honestly, not a lot of people do it. Do people, some people do? Yes. Do we do them? Yes, we do. But they're not easy, folks.
You know what solves problems is money, right? So if you've got the money to spend, you can do the reverse exchange, you can do the construction exchange, okay? But just know that those complicated issues and those complicated deals, they cost more to do, all right? Money will solve your problem. It's whether or not you want to pay for those solutions or not, right? So you can get those done. I got a bunch of other questions here. We have questions about LLCs and tax entities. Adam, you want to talk about some of the problems and complexities that come up when people own properties in LLCs? And maybe I'll couch this for you. Maybe you can start with, the two types of LLCs that we have. One being kind of the disregarded and the other one being the regarded LLCs.
Yeah, so for the 1031 exchange, we are just a number to the government, guys. We're literally a number that they look at from the sale to the purchase. They want to make sure that the same tax ID number that sold is the same tax ID number that purchases. So when you think of LLCs, you think of, well, there's a potential for a LLC to be treated as either your tax ID number or a completely separate tax ID number. And so when you have a single member LLC that's a disregarded entity, then it's still filed on your personal tax returns. But if you have an LLC that has its own tax number and files a K1, well, then that one has its own tax ID number and is not filed on your personal tax return. So you just want to make sure that it matches from the sale to the purchase, no matter what entity is on title.
And if you're not sure what that is, call your CPA, because you might be getting a K1 and you've been declared on your tax return, and you want to make sure you're not part of a non-disregarded entity. Because if you are, you don't own the property, folks. The LLC does.
Those are important questions to ask too, because I don't know how often, we'll be setting up an exchange for our client and the client says, well, yeah, I own the property. Then we pull the title report and there's an LLC on title. And we ask the client, well, is this LLC disregarded, or, how are you treating the LLC for tax purposes? And they don't know. And so we're scrambling around kind of last minute to figure this stuff out. So let's get those title reports pulled, get us involved early, right, in the process. I know sometimes clients don't make up their mind until the day before closing that they want to do an exchange. But if you know your client's even thinking about it, get us on the phone, because, if it's a month away, 6 weeks away, 6 years away, if we can ask those questions, it's going to make the transaction go a lot smoother. A couple other things here, guys. Do you consult with clients on an hourly basis, Phil?
Well, seems like it goes longer sometimes less. But the answer is yes. We're happy to consult, to give you our opinion on how it works. We have a lot of experience here on our team, and we can tell you what to expect and what pitfalls you have to watch out for. Then we'll send you back to your CPA with that information, and you make a decision if this is the best move for you. Do we charge for that consultation? No, we do not. We give you this information because we want you to make a decision as to what's best for you, not for us. And that's why we give it to you.
Here's what we ask though. If you're gonna, spend an hour chatting with Phil or Adam or myself, don't go and then use another exchange company, right? Please use us for our expertise, and then also use us for the actual deal. One other question, and then we'll start to wrap up here because I think we're almost out of time, or maybe we're a little bit over now. It's regarding deposits. So we have an exchange, we're holding funds for the client. Adam, how does the client who wants to go out and buy a property get money for the deposit? A couple options, right?
Yeah, so there's a couple options. So the first option is if we're holding the funds, we can send the earnest money deposit to the replacement escrow. But yes, that does require you to notify us that you're in escrow on a purchase and send us the relevant contact information so we can get that money over there. And alternatively, your client or you yourself can pay for the earnest money deposit on your replacement property and then get reimbursed at the close of escrow on your purchase. And if you ask any escrow person, they're going to ask you to have us send the money instead of having to cut you a check and reimburse you at the end of it.
All right, a couple other things come up. Williams asked a question, but it looks like he left and I didn't understand his question. Anyway, Vivian wants to know, Phil, this 323 number is the one I should put in and save, right? So go ahead, Vivian, save that one. I think we're gonna go ahead and wrap it up now. If we didn't, a couple other questions popped up, but we're gonna close out here. So Jesse, go ahead and email us. Thank you guys all very much. We do these on a frequent basis, so keep an eye out for our emails for our next ones. Appreciate all the great feedback and look forward to working with all of you on your next deal. Thank you very much, everyone.